Okay, let's unpack this. I have to be honest, preparing for today's deep dive, I had this real sense of unease.
Oh!
Yeah. You know that feeling when you find a document that just feels like it shouldn't exist? Like you're reading something almost blasphemous to the industry.
I know exactly what you mean. And with this slide deck, I get it. We're not just reviewing some new strategy today. We are effectively taking a sledgehammer to one of the most sacred concepts in technical analysis.
We are talking about divergence.
Yeah.
I mean, if you spend 5 minutes looking at a stock chart, crypto, Forex, you know what this is. It's the classic signal.
It's in every textbook, every YouTube video.
Exactly. But the source material for today is this deck called The Divergence Delusion. And the very first slide, it's an image of a cracked speedometer with the subtitle, The Math of Deception.
It really doesn't pull any punches. And I think we should say right up front, this isn't just some angry post on a forum. That's the first thing I checked.
Right. Who is this person?
Yeah.
The author claims to be a veteran, 35 years in the markets. And get this, he says, this analysis comes from looking at over 10 million trade points.
And that's the key. This isn't just an opinion. It's a claim based on a massive data set.
Yeah.
And the thesis is, well, it's shocking. The deck basically says divergence is not a market phenomenon. It's not the market sending you a secret message.
It's a mathematical error.
That's it. The quote is, what you think is a trading signal is actually a calculation bug.
And that is a disturbing thought, because if that's true, a lot of very smart people are trading a glitch.
Precisely. So our mission today is to just go through this deck page by page and really see if this claim holds up.
Can I be honest? I'm going to play the skeptic here.
Yeah.
I've used divergence. I know people who swear by it. I've seen it work. So you're going to have to convince me.
Deal. Let's start with page 3, the setup.
Okay, yeah. This is the holy grail. For anyone listening, let's just paint the picture. What are we seeing on the screen here?
Okay, so you have your price chart. Bitcoin, Apple, whatever. The price is rallying hard. It makes a new record high. We call that a higher high.
So on the surface, everything looks strong. The bulls are in complete control.
But then you look down below the price at your oscillator, your RSI, MACD, something like that. And while the price made a new high, the indicator, it fails to. It makes a lower high.
So price is screaming strength, but the indicator is sort of whispering weakness.
That's the classic story. And the interpretation we've all been taught is that this is buyer exhaustion. The market is running out of gas. A reversal is just around the corner.
Feels like you have X-ray vision, right? That's why traders love it. You think you're seeing the market's hidden intent before anyone else.
It's a very romantic idea. But this is where the author says, stop romanticizing and look at the math.
So what's the counter argument? If it's not exhaustion, what is it?
The deck claims what you're seeing is not fading momentum. It's a calculation lag.
A lag.
Yeah.
It sounds way less exciting.
It is less exciting, but it might be more true. The whole idea is that the indicator isn't predicting anything. It's just struggling to keep up with the price. And to see why, we have to look at the formula on page 4.
Okay, page 4. The RSI formula. I see a bunch of algebra. Do we really need to get into the weeds with this?
We don't need to do the calculus, but we absolutely need to understand the logic. Otherwise, we're just flying blind. The standard RSI looks at the past 14 candles.
Right, the 14-period look back, default setting everywhere.
And the critical part isn't the number 14, it's the mechanism. It uses averaging. The deck calls this the dilution effect.
Dilution, like watering down a drink.
Exactly like that. Think about it. When a brand new candle forms, the price action happening right now, that one piece of data gets dropped into a bucket with the last 13 candles.
So the now is being averaged with the then. The present is being mixed with history.
Yes. The indicator is literally weighed down by the past. The number it spits out is a blend. It's not a pure reflection of what's happening this second.
Okay, I get that. It's an average. But why does that create this illusion of divergence? Why does the indicator go down when the price goes up?
And that's $1 million question. Page 5 is, I think, the most brilliant part of this whole deck. It gives us the home run paradox.
I love this analogy. This is what made it finally click for me. Let's walk through it.
Okay. Imagine a baseball team. For their last 13 at-bats, they've been hitting weak singles, barely getting on base.
Right. So in market terms, that's like a choppy sideways market. Not much happening.
Correct. Weak price action. But then, on the 14th at-bat, the batter just smashes a massive home run. The ball goes farther than it ever has before.
That's our price spike, the new high on the chart.
Exactly. The price is at a record high. It's an explosive move. But what happens to the team's batting average?
Well, it barely moves. I mean, it goes up a little, but that one home run is being averaged against all those weak hits before it.
Precisely. The batting average is diluted by that history of mediocrity. So you have this paradox where the ball, or the price, is at a record high, but the average, the indicator, is still way down here.
Yeah, that's the divergence.
That's the divergence. The indicator makes a lower high, not because the batter is getting weaker, he just hit a home run, he's stronger than ever. It makes a lower high because the math, the average, is just too slow to catch up to that sudden explosion.
Wow. Okay, just let that sink in. We look at a chart, we see price up, indicator down, and we think the market is exhausted. But what's really happening is we're just looking at a batting average that hasn't updated yet.
You're mistaking arithmetic for market sentiment. In this view, divergence isn't a sign of reversal. It's just proof of a sudden acceleration that the formula can't handle.
The math is lagging behind reality. It really does take the magic out of it, doesn't it?
It should. Because if you're betting your money on magic, you're eventually going to get burned. If you're betting on math, at least you know the rules of the game.
Which brings us to pages 6 and 7. The author makes this distinction between velocity and memory.
This is fundamental. Price is instant velocity. It's what's happening right now. Full stop. It's raw data.
But the indicator?
The indicator is calculation memory. It's dragging this heavy bag of old data behind it. So when the price suddenly takes off, the indicator is still mathematically remembering those slow, choppy days from 2 weeks ago.
And the analogy they use here is the broken speedometer. This is where it gets really dangerous for a trader.
It's a great image. You're in a car, you slam your foot on the gas pedal, you're accelerating to 120 kilometers per hour. That's the real price speed.
Okay, I'm flying down the highway.
But the speedometer on your dashboard has a 3-second lag. So even though you're doing 120, the needle is just slowly creeping past 80.
And that's the trap. A trader looks at the gauge, they see 80, but they feel the car going 120.
And what do they conclude? Oh, the car must be slowing down. Look, there's divergence between my speed and the gauge. I should short the car.
That's insane. You're not slowing down. You're just trading based on a faulty gauge that hasn't caught up.
And if you try to short a car that's accelerating, you're going to get run over. That is the core warning here. You are trading a broken gauge.
But I have to push back here. We've all seen it work. We've seen divergence form and then the price does reverse. If it's just a bug, why does that happen?
It's a great question. The deck's answer is basically, it's the broken clock is right twice a day syndrome.
Yeah.
Sometimes a massive price spike is the final move, a blow off top.
So a coincidence.
It's a correlation, not a causation. The indicator didn't predict the top. The indicator was just lagging, and the top happened to occur around the same time. You're giving predictive power to a coincidence.
Or maybe the self-fulfilling prophecy. Everyone sees it and sells.
That's also possible. But do you want to base your entire strategy on a prophecy or on something structural? The author is saying that relying on lag is a horrible way to manage risk.
That's a fair point. Yeah. But it still begs the question, why is this idea so widespread? I mean, we're talking about very smart people, quants, PhDs. Why do so many people fall for this?
The author argues it's an intellectual trap. It comes from confusing the principles of physics with the reality of markets.
Physics versus markets. Okay, break that down.
On pages 8 through 10, he talks about Brownian motion. It's a concept from physics that describes the random movement of particles, like dust floating in a sunbeam.
Right, the random walk theory. Standard finance loves that model.
It does, because it's neat and clean. These models treat the market like particles in a box. They assume price moves randomly, and this is the most important part, that a particle has no memory.
A particle doesn't care where it was a minute ago. It just moves.
Exactly. No memory and no feelings. A particle doesn't feel regret or fear or greed.
But traders do.
And that is the huge human element that the math misses. The deck says markets are not particles, they are people. And people have memory.
This is where it gets into trauma and trapped buyers. I found this part fascinating because it shifts from pure math to psychology.
It's crucial. Think about someone who bought at the absolute peak of a bubble. The price then crashes. That person is now trapped, holding a huge loss.
Every day they look at their account, they feel that pain.
They are a trapped buyer, and they have a very, very strong memory of that price level. They are just praying for the price to get back there so they can sell and get their money back.
So that price level isn't just a random number anymore. It's a point of emotional pain for thousands of people.
Correct. And that is what creates real resistance. The slide on page 10 shows this visually. It's a cluster of humans waiting to sell. That's real.
I see. So true resistance isn't some imaginary line that an oscillator draws when it hits 70. It's a wall of people who are in pain and want out.
Exactly. Price moves because of liquidity and memory, pain and greed. Not because a 50-year-old formula crossed a line. The author says it perfectly. Particles don't remember pain. Humans do.
That completely reframes how you should look at a chart. If you're only looking at it through a physics lens, you miss the entire emotional landscape.
You miss what actually drives the market. And that's why these models always break during a panic. They expect a gas cloud, but they get a stampede.
Okay, so we've debunked the Holy Grail. We've shown the math is just a lag. We've seen that physics models are flawed. And now we get to page 11. This one felt like a gut punch.
Your weapons are toys.
Ouch.
It is a systematic dismantling of the average trader's toolkit.
Let's just go through the list. First, chart patterns. Your head and shoulders, triangles, flags.
Dismissed as pareidolia.
Seeing faces in the clouds.
Yep. The deck says the market didn't draw a bull flag. Your pattern-seeking brain did.
Okay. Next, divergence.
Dismissed as lag. A calculator bug, not a signal. We've covered that.
And finally, physics models.
Dismissed as delusion because they ignore the human, they ignore the pain and the memory.
So basically everything I learned in my first year of trading is useless. It feels like he's just stripping everything away.
It can feel that way, but I think the goal is to clear the board. You can't build a solid house on a rotten foundation. You have to tear down the bad ideas first.
Which takes us to page 12, the shift. If all our weapons are toys, what's left? Are we just supposed to guess?
No, this is the pivot. The author argues for a shift in mindset, from prediction to exploitation.
Prediction versus exploitation, what's the difference?
Prediction is what we've been talking about, looking for omens. The RSI is overbought, so the price must go down. That's fortune-telling with a broken speedometer.
Okay, so exploitation is?
Exploitation is acting like a data scientist. It's asking where are the structural flaws in this market I can take advantage of.
What's a structural flaw?
Those track buyers we talked about. That's a structural flaw.
Yeah.
You know, with high certainty that if the price returns to that level, there will be a flood of sell orders. Not because of a magic indicator, but because human beings want to stop the pain.
So you're not trying to guess the future. You're identifying areas where you know people are trapped. You're trading the pain points.
You're trading the liquidity and the memory. You stop asking what might happen, and you start asking, where's the money tracked right now?
It's like going from being an astrologer to being a mechanic.
That's a perfect way to put it. The astrologer reads the stars. The mechanic looks at the engine. This deck wants us all to be mechanics.
We're at the end now. Page 13 has this final, really provocative question that just sums the whole thing up.
I'll read it. Are you trading the market, or are you trading a mathematical artifact of a 50-year-old formula?
That just sticks with you, doesn't it? It forces you to question what you're even looking at on your screen.
It does. It makes you ask, am I seeing the real battle between buyers and sellers, the fear and the greed, or am I just looking at a line that is mathematically designed to be leaked?
It's been a ride. We started this deep dive thinking about a holy grail signal, believing we could see the future.
And we're ending with the realization that we might have just been trading a math error this whole time, staring at the batting average instead of watching the home run.
But it's also liberating in a way. If you stop hunting for the magic trick, you can start looking at the reality of the market. You can stop blaming yourself when it doesn't work.
Yes, the reality is messy, but it's real. The true holy grail isn't an indicator. It's understanding the why behind the move.
So here's the challenge for everyone listening. The next time you open your charts, tomorrow morning, whenever, look at your RSI, your Mankey D, look for that divergence.
And ask yourself, am I actually seeing market intent? Or am I just watching an average that hasn't caught up to reality yet?
Stop looking for omens. Start respecting the raw data.
And remember that particles don't have feelings, but the person on the other side of your trade definitely does.
Thanks for this. You successfully ruined my favorite setup.
Anytime. It's always good to break a few speedometers.
That's it for this deep dive. We'll see you all next time.